Money and credit are the backbones of our economy. They are the lifeblood that keeps the wheels of commerce turning, enabling transactions and fostering growth. Without them, our modern world would come to a standstill. They haven't always been around in the forms we see today. The journey of money and credit is a fascinating tale of innovation and adaptation, reflecting the changing needs and complexities of human societies. Long ago, people used a system called bartering. This was the earliest form of trade where goods and services were exchanged directly without any intermediary. This meant trading one good or service for another. For example, a farmer might trade a basket of vegetables for a blacksmith's tools. Imagine trading a basket of apples for a new pair of shoes. While this system worked, it had significant limitations. As you can imagine, bartering wasn't very efficient. It required a double coincidence of wants, meaning both parties had to have what the other wanted. It was hard to find someone who had what you needed and wanted what you had. This inefficiency led to the development of money. This is where money came in. Money provided a common medium of exchange, making transactions smoother and more efficient. Money acts as a medium of exchange. It is a universally accepted item that can be traded for goods and services, eliminating the need for a double coincidence of wants. It's something everyone agrees has value and can be used to buy goods and services. But what about credit? Credit is another crucial component of our financial system. Credit allows us to buy something now and pay for it later. This concept has revolutionized the way we make purchases and manage our finances. This is incredibly helpful for large purchases like houses or cars. Instead of saving for years, people can acquire what they need and pay over time. It allows people to achieve their dreams sooner rather than later. However, with great power comes great responsibility. Credit, however, needs to be used responsibly. Mismanagement can lead to debt and financial troubles, which is why understanding credit is so important. Understanding how money and credit work is crucial for navigating today's world. Financial literacy empowers individuals to make informed decisions, avoid pitfalls, and seize opportunities. It's the key to making smart financial decisions and achieving your financial goals. By mastering the concepts of money and credit, you can pave the way to a secure and prosperous future. Banks are essential players in the world of money and credit, but what exactly are they? Banks are businesses that hold our money, facilitate transactions, and lend money. Think of them as financial intermediaries. There are several types of banks, each with its own specialty. Commercial banks are the most common. They provide services that most people use, like checking accounts, savings accounts, and loans. Investment banks work with businesses and governments. They help these entities raise capital and make investments. Central banks oversee the entire banking system of a country. They control interest rates and the money supply. Banks play a crucial role in our economy. They keep money flowing and make it possible for businesses and individuals to thrive. Banks make money through a system called fractional reserve banking. This means they only keep a fraction of your deposits on hand as reserves. The rest is lent out to other customers. When a bank makes a loan, it charges interest. This interest is how banks profit. They also charge fees for various services. These fees help cover their operating costs. Banks are carefully regulated to ensure they are operating safely and soundly. These regulations help protect your money and the overall financial system. Knowing how banks operate helps you understand the importance of interest rates, fees, and the overall financial landscape. Money and credit are the lifeblood of any economy. They keep businesses running, people employed, and goods and services flowing. When money is easily accessible and credit is readily available, economies tend to grow. Businesses invest, people spend, and jobs are created. However, too much money in circulation can lead to inflation. Inflation is when prices for goods and services increase over time. This can erode the value of your money. Central banks keep a close eye on inflation and adjust interest rates to keep it in check. Understanding the interplay between money, credit, and the economy is essential for making informed financial decisions. Section 5. Different types of credit. In this section, we will explore the various forms of credit available to consumers, and how each type serves a unique purpose in managing personal finances. Credit comes in many forms, each designed for a specific purpose. Understanding these different types can help you make informed decisions about borrowing and managing debt. Personal loans are lump sums of money that you borrow and repay over a set period. These loans can be unsecured or secured, depending on whether collateral is required. They can be used for various needs, such as home improvements, debt consolidation, or even unexpected expenses like medical bills. The flexibility of personal loans makes them a popular choice for many borrowers. Mortgages are specifically for purchasing a home. These loans are typically large sums of money and are secured by the property itself. These loans are typically paid back over 15 or 30 years, making them long-term commitments. The length of the loan term can significantly impact the total amount of interest paid over time. Interest rates on mortgages are usually lower than those on personal loans. This is because the loan is secured by the property, reducing the lender's risk. Credit cards offer revolving credit, which means you can borrow up to a certain limit and make monthly payments. This type of credit is very convenient for everyday purchases. This means you can borrow up to a certain limit and make monthly payments. However, it's important to pay off the balance each month to avoid high interest charges. Credit cards are convenient but can be dangerous if not used responsibly. High interest rates and fees can quickly add up, leading to significant debt. Lines of credit are similar to credit cards, but they typically have lower interest rates. They provide flexibility for borrowing as needed, up to a predetermined limit. They are a good option for short-term borrowing needs, such as covering cash flow gaps for small businesses or funding home repairs. Knowing the different types of credit can help you choose the best option for your financial situation. By understanding the benefits and risks associated with each type, you can make more informed decisions and manage your finances more effectively. Section 6. Using credit responsibly. Credit is an essential part of modern financial life. It allows us to make significant purchases, manage cash flow, and even earn rewards. However, it's crucial to understand how to use credit responsibly to avoid falling into debt traps. Credit can be a powerful tool when used wisely. It can help you build a strong credit history, which is essential for securing loans for major life events like buying a home or starting a business. It can help you achieve your financial goals and weather financial storms. For instance, having a credit card can provide a safety net during emergencies, allowing you to cover unexpected expenses without immediate cash on hand. However, irresponsible credit use can lead to a mountain of debt. This can happen quickly if you start relying on credit for everyday expenses without a plan to pay it off. The key to using credit responsibly is to live within your means. This means creating a budget and sticking to it, ensuring that you only charge what you can afford to pay off each month. Don't spend more than you earn, and always make your payments on time. Timely payments not only help you avoid late fees, but also positively impact your credit score. Late payments can damage your credit score and cost you more money in fees. It's essential to set reminders or automate payments to ensure you never miss a due date. It's also important to keep your credit utilization low. This means not maxing out your credit cards and keeping your balances well below your credit limits. Ideally, you should aim to use no more than 30% of your available credit at any given time. High credit utilization can hurt your credit score. A lower credit score can make it more challenging to get approved for loans and can result in higher interest rates. Remember, credit is a tool, not a free pass to spend beyond your means. It's about making informed decisions and understanding the long-term impact of your spending habits. Use it wisely, and it can work in your favor. Responsible credit use can lead to financial freedom and the ability to achieve your dreams without the burden of debt. Use it carelessly, and it can have serious consequences. Always be mindful of your spending, and remember that every swipe of your card is a step towards your financial future. Section 7. Understanding credit scores. Your credit score is a numerical representation of your credit worthiness. It tells lenders how risky it is to lend you money. A higher credit score means you're considered less risky, which can result in lower interest rates and better loan terms. Several factors influence your credit score. Payment history is one of the most important. Late payments can significantly lower your score. Credit utilization also plays a major role. The length of your credit history is another factor. Having a longer credit history is generally better. The types of credit you use also make a difference. It's essential to check your credit report regularly for errors. You can get a free credit report from each of the 3 major credit bureaus annually. Section 8. The importance of financial literacy. Financial literacy is the ability to understand and effectively use various financial skills. It encompasses concepts like budgeting, investing, and managing debt. In today's increasingly complex financial world, financial literacy is more important than ever. It empowers individuals to make informed decisions about their money. There are countless resources available to help you improve your financial literacy. Books, websites, and even financial advisors can provide valuable information and guidance. Investing in your financial literacy is an investment in your future. It's never too late to start learning and taking control of your finances. Section 9. Conclusion. Taking control of your finances. Understanding money, credit, and banking is crucial for navigating today's financial landscape. By grasping the basics of these concepts, you can make informed decisions that will set you up for financial success. Remember, knowledge is power. The more you understand about money and credit, the better equipped you'll be to manage your finances effectively. Take control of your financial future by continuing to learn and grow your financial literacy.